Hello and welcome to Portfolio Matters Week 7.
Hello.
And this is our usual weekly update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So what have we got this week, Keith?
Thank you, Richard. Well, once again, I didn't think there was actually much relevant news in the market. So we're going to go straight into the charts that caught our attention this week. And this first one is the Buffett indicator, which attempts to show whether the stock market is fairly valued. And you can see here that according to the Buffett indicator, we are now at the most overvalued ever, higher than the dot-com bubble in 2000. Okay. So beware.
Yeah, I mean, the interesting about this is that there are pretty much every indicator that you look at that measures valuation says the markets are overvalued. And the share markets continue to go up. And
absolutely.
I mean, it's just
Well, I would also say, Richard, that, when you look at the broad market in aggregate, you squash together lots of different things. I mean, it's clearly the technology sector. I mean, the price of Tesla is absolutely absurd.
Yeah.
But if you look at, the price of oil companies, they are still very low compared to historic averages. So, I think this hides a multitude of different stories.
Yeah, I think it's a very good point, Keith.
And on that note, this chart shows the energy sector as a proportion of the S&P 500.
And as you can see, this is basically oil and gas. Is that right, Keith?
That's right. Yeah, oil and gas. Sorry, as a percentage of the S&P 500, and as you can see, over the last decade, it has declined from over 12% of the S&P 500 to just over 2%, and it's ticked up a bit recently. But real assets like energy have increasingly fallen behind as the market has become enamored of high-tech companies trading on enormous multiples. And is this the beginning of a reverse?
Good question. You could have asked that in 2015.
Yes, I know. So this is the a chart from an energy analyst I really like and respect called Art Berman, and he is very active on Twitter if you're interested. And these are his forecasts in red, blue and green for the outlook for US oil supply. And the black line is the US Energy Information Authority's reference case. So the EIA is forecasting the US oil production will rapidly return to new peaks, whereas Art Berman is saying it won't.
Okay, is Art Berman basing his on projected prices or projected ease of recovery from shale? What's the sort of basis of his thesis?
It's based on looking at the underlying. So what basically the ease of how much high grade shale is left,
right?
Like the decline rates of the current wells and the fact that nobody's been investing in them. So offshore, there's been a dearth of exploration, and increasingly outside the Permian, the core areas have been drilled.
That's a synthesis of a number of different factors, and he's taking obviously a very different view to the EIA.
Exactly, that's right. Yeah. So essentially, he's saying all growth will come from the Permian.
Yeah.
So anyway, something to watch out for. If he's right, oil prices stay high and go higher.
In 5 years' time, we've got a difference of about 2 million barrels. Well, if you go for his most likely, we've got a difference of about 3 million barrels a day.
Yeah.
Which
yeah.
is
So
3% of world consumption, roughly.
That's right. But the thing is, this adds to a general picture of underinvestment in oil, Richard.
Yeah. Okay.
Now, it is exactly a year, apparently, since the first kind of COVID alerts. And this is the returns of all the major asset classes in those 12 months. And Richard will be happy with this chart because everything else are just a few squiggly lines at the bottom. And the two that stand out are Ethereum, which is the silver line, and Bitcoin, which is the gold line. And talking of which, Richard.
Thank you, Keith. Well, it's been another good week in the Bitcoin and Ethereum cryptocurrency markets. New weekly highs for both Bitcoin and Ethereum. And I think there's quite a lot of signs of life in what's generally known as the altcoin market, where people sort of buy these various, apparently there are 7,000 of them, these various altcoins in the hope of making a large, rapid, speculative gain, which undoubtedly relies on the greater fool principle. I think there are a few so-called altcoins that may actually have some sort of economic value in the future. And obviously, many people still think that Bitcoin is a greater fool principle investment. My view is not that, but I acknowledge that I may be wrong. If you go on to the next slide, Keith, we just have the chart of Ethereum, which is showing exactly the same thing. It's reached a new weekly high. So with increasingly a parabolic curve upwards, and be careful.
Well, I think in the short term, Richard, that all these things are going to squeeze higher. I listened to a very interesting podcast during the week on how the various corporates who had decided to put a load of money into Bitcoin, their share price had absolutely shot up, which obviously encourages other companies to also put money into Bitcoin.
Well, I think they turned themselves into a proxy cryptocurrency. And so, in fact, if you struggle, whatever, to buy Bitcoin, or you can buy shares in MicroStrategy, for example, and actually you're owning a chunk of Bitcoin in months. I also heard this week that MicroStrategy, which is one of the first companies to decide to use Bitcoin for its corporate treasury, is issuing a bond for $900 billion with the express intention of buying Bitcoin with that $900 billion. So it's effectively saying, give me your dollars, we'll invest it to a lender, we'll pay you whatever, 1% per annum, we'll invest it in Bitcoin and we'll enrich ourselves while leaving you with the pauper's currency. I mean, that is the message.
Well, yeah, absolutely. Well, to me, this is very reminiscent of the South Sea bubble.
Yeah.
The thing is, as it squeezes higher, I mean, if you remember, Sir Isaac Newton lost a hell of a lot of money on the South Sea bubble because it reached the stage where everyone was getting rich, and finally he just couldn't resist and he got in towards the top. And I think we're definitely in the stage where it squeezes higher and higher.
I don't actually know what the free float of Bitcoin is, but the so-called whales hold a large chunk of it. So whatever the capitalization is, there's much less actually available in the market. So it doesn't actually take many people to come in and start buying to push the price dramatically. Absolutely.
So, but I think we are definitely in the latter stages of this. Now, it could squeeze a lot higher, but all bubbles come to an end.
Yeah.
Okay, so on to the weekly checklist and equity markets. Well, for once, the UK, actually the FTSE All-Share outperformed the rest of the world. FTSE was up 1.5%, whereas all the other markets were down slightly. Bitcoin, once again, is the standout, up 9%. Sterling had a good week, up 1.4%. Moving on to industrial commodities, they all have kept on going higher. I have been surprised by the strength of copper, keeps on hitting new highs, up 4% on the week. Iron ore up 6%. Now, both lithium and neodymium I wonder whether the charts have been updated. I checked various sites, but there seemed to be no change on the week, which seems suspicious to me.
Mm-hmm.
So I would be slightly wary of those numbers.
Okay.
Nickel is up. Basically, everything is up apart from lithium and neodymium. I found that suspicious, frankly. And WTI also had a good week. It was above $60 for a couple of days, but settled back down today.
Okay. So this is the CRB index, the commodities index, which is a mix of industrial metals, oil, and agricultural commodities. I think the point here is that I don't know if anybody was screaming in 2011 that commodities were hugely overvalued, and we have moved a little bit back towards that point in 2011, 370 or so. There's another 70 or 80% rise in the general commodity markets to regain the 2011 point. And yeah, that's prima facie, that doesn't seem unreasonable. And it doesn't seem like it would be a bubble phase. That's not to say it is or isn't going to happen, but if it were to happen, you wouldn't say, God, everything's in a dreadful bubble.
Yes, but once again, the index, squashes together lots of different things, Richard. I think if you look at the price of rhodium, I mean, it's absolutely very extended, but the price of oil is not.
Yeah.
You know what the weighting of oil in the CRB is?
I don't off the top of my head. Next week, we'll put the weightings in.
Great. Okay. So this is the iron ore price, and it's shot back up towards new highs.
Mm-hmm. Lithium, as Keith pointed out, the price of lithium hasn't changed. Graph shows that.
Yeah.
So these are just a couple of points that I took note of during the week and wanted to mention in our commodity section. So I've put the subheading, green energy, electric cars, no more fossil fuels, ? And then I guess the points are, well, we've got the energy emergency in Texas, where the Texas power grid is incapable of surviving this cold weather for a number of reasons. Wind power has frozen up. I don't think there's been much solar generation there. Their nuclear power station wasn't winterized. I think they didn't winterize it because Texas doesn't generally experience very cold weather. So they had to shut their nuclear power station, which produced 2.2 megawatts. I don't mean megawatts, do I? I must mean gigawatts. They had to shut that down. And basically, what this is saying is that the energy network in Texas cannot cope with a significantly increased demand. And I think for Texas, read the developed world in general. So I was listening to a professor. She was a professor. She was being interviewed on Radio 4 news program. And unfortunately, I didn't get her name or the organization for which she worked. But she was being asked about what happens if we electrify the UK. And she basically said, replace all internal combustion vehicles with electric vehicles in the UK would require a doubling of the generation grid. So that's a doubling of the carrying capacity, a doubling of the generation capacity. And if you then remove natural gas and replace that with electricity, that would require a tripling of the grid in conjunction with internal combustion removal. So what this says is and I know there's no particular plans to replace all natural gas with electricity, but there are plans to replace quite a lot of it, or ideas. This simply can't be done without massive, massive infrastructure expenditure. And for the UK, again, read the developed world, in my view. So we are looking at two things, probably an essential slowdown in the pace of change and a massive spend on infrastructure. And with car companies all around the world announcing they're going to go electric, well, the electric cars will be built and the grid won't be able to charge them. And we are heading for a sort of big discontinuity, like the engineers building the bridge from two sides of the river, and the bridge doesn't meet in the middle. And this, I think, is an issue that isn't being discussed at the moment. But copper, price goes up. Fossil fuels, we need them. Are we exploring, as Keith says? No. And are we investing? No.
Thank you, Richard. That's really interesting. And actually, there was a report in the FT this morning, which you may have read, about exactly this issue,
right,
going in the US state of Maine. So they are trying to increase the power supply, so increase the number of pylons going across the county in order to allow more renewable energy on the grid. And they're getting very strong pushback from residents who don't want pylons going across the country. And essentially, as you increase the amount of renewables in the grid, you need to increase interconnectivity.
Because you have a much more distributed generation system.
Precisely, that's right. Moving on to precious metals, gold had a poor week. Silver was kind of flat. Platinum, which we covered in a special podcast, is going up. Rhodium had a great week. So rhodium's main use is in catalytic converters for the nitrous oxides, and in next year the EU is tightening emission standards and rhodium is being squeezed up. And if we look at the sorry, I'm going to skip forward, the price of rhodium, I personally think it was a struggle to get much higher, but it is squeezing up. And apparently Goldman Sachs are forecasting prices of between $50,000 and $100,000 an ounce in this year.
And I think from recollection, Keith, it was Sylvania Platinum is a rhodium producer, isn't it?
It is, yes.
Most of its profits from rhodium.
Exactly. I urge everyone to watch our little share talk on Sylvania. I bought some. So Richard?
Okay, so Keith, this is, I mean, I'm just fascinated by the gold market because I know some people consider that manipulation is a, quote, conspiracy theory. I think most markets are manipulated, aren't they? But the what interests me about this is that this is the reported longs on the COMEX. So this is the paper gold positions as opposed to physical gold positions, and how they've tripled since like mid 2019. So in a year and a half, and they now equate to 545 tons of gold. So the which is actually 20% of annual production. And it's just extraordinary to me that the price of gold isn't going up, especially. It hasn't moved for quite some time now, months. And yet the number of paper gold positions is going up in a straight line at 45 degrees on this graph. And there is a disconnect here. And I always think that, you know, where there's a disconnect in the market, at some point that disconnect breaks or the reconnection occurs. And in this case, two things can happen. Either demand for gold drops, or and then these positions can be exited, or demand for gold increases and these positions cause serious financial problems for people owning them.
I would actually push back slightly on that, Richard, in that I think in the long term, gold obviously should keep its value with match inflation. And as the central banks of the world are printing lots of money, then medium term gold absolutely should go up. But in the short term, gold is subject to supply and demand constraints, just like every other market. And the thing about gold is 30% of demand generally comes from jewelry. And as everyone is locked in their houses and there are no weddings, then jewelry demand has collapsed. And I expect that when we get out of lockdown and people start actually, you know, socializing again, that will return. But in the short term, you know.
Yeah, that's a fair comment, Keith. Oh, so this is the gold price versus the 5-year tips, which everybody says that the price of gold tracks 5-year tips. Until it doesn't, obviously. and it's got tracking. So the Bullion Buy Post website, I like to check this every week now, just to see what's happening on the silver side. So you can see last week's. Unfortunately, I did last week's in dollars, which I didn't notice. But this week, nothing is available except the 2020 Britannia, which is now £47, as opposed to $31, which is what it was last week.
Yeah. Well, you convinced me, Richard. I bought some silver during the week.
Did you?
Yeah, I did.
Well done, Keith. So I just came across this, fortuitous really. I was reading about antimicrobial floor surfacing, and obviously everybody's very concerned now about keeping our places microbe-free. So this is a combination of silver and tungsten, titanium in a floor coating. What happens is you apply this to the floor. There's a photochemical reaction with ultraviolet light, or just light. Light hits the floor coating and causes oxygen-free radicals to be released. The oxygen-free radicals kill bacteria and viruses. So we now have another use for silver, which is in floor coverings. And one can see that in a couple of years' time, people will say, if it hasn't got this antimicrobial coating on it, I won't buy it. Well, I don't know how you invest in it. I did check. I couldn't find any way of investing in it.
Well, that is really interesting, Richard. Thank you. I would say I would not be a buyer of this, though. I think you need a decent number of bacteria and mold in the house to keep your immune system going. Yeah. So.
Well, I would agree with you, Keith. I agree with you.
But anyway,
I'll just go back quickly. If anyone's interested in looking up antimicrobial activity of photocatalysts, fundamentals, mechanism, kinetics, and recent advances, I haven't read it, but I found it.
Right, very good. Well, thank you, Richard. Rhodium we've covered.
So uranium. I'm intrigued by uranium. So this is the price of uranium. Obviously, it's been trending downwards now for the best part of 12 months. And then Keith moves on to the next chart. This is the uranium miners ETF, which has at some point doubled from October or so until now. And there's a clear disconnect between the two. Everybody's saying we're going to be using nuclear power to bridge this gap between fossil fuels and renewables. So it's always going to exist. Nuclear power is the way, quite probably so. But nuclear power stations take many years to build, and you can have 100 being built now, but they won't be built for 5 years, and in that time, the uranium demand isn't there. So it just strikes me that the demand isn't sufficient to push the price up at the moment, and that the uranium miners have gone up in anticipation, but probably possibly too early.
Well, I completely agree with you, Richard. The thing is, how long have we been hearing that there's a fundamental shortage developing in the uranium market?
5 years.
I think it's been at least 5 years. And, you know, the uranium price continues to do nothing. I mean, it's picked up. I think it's, as you showed in the first graph, it's drifting off again. I think investors have more enthusiasm for this than the market actually supports.
So I know Cameco, one of the largest uranium producers, has shuttered all production now and is fulfilling its long-term contracts by buying uranium on the spot market.
Wow.
Well, so when the price of uranium goes up, it simply opens up its mines again. And there's still no shortage.
Yeah, absolutely. Yeah, that's a really good spot, actually. I wasn't aware of that.
Yeah, that's interesting.
Just moving on to the seasonality chart. The dog days of February we're in currently, so don't expect any.
We're coming towards the worst of the dog days, Keith.
Yes, well, yeah, exactly. On to rates now. This is actually, I think, really quite important. So the UK rates are moving. And actually, we are now, the 30-year rate has moved firmly above 1%. And all the rates move quite strongly. Now, we did have an update on January RPI and CPI. So RPI ticked up to 1.4% from 1.2% in December. CPI, they downgraded December CPI to 0.6% from 0.7%. And then they put in January at 0.7. So CPI is kind of flattish, but RPI is ticking up. And if we look at the 5-year at the top, the 30-year gilt yields, you'll see they're increasing quite quickly. People are anticipating inflation. And what this absolutely tells you is you now have a gap between short-term rates, which are anchored at 0.1%, and 30-year rates, which are now rising rapidly. And this morning, I bought Barclays and Lloyds because this is their spread. This is how they make their money. And this is CPI, so CPI is quiescent.
So this is a couple of graphs for the Financial Times showing what's happened to airline bookings, and they are falling again. They have fallen again, having been on sort of gentle upward trend. The domestic flights have recovered a lot more than international flights, which is what you would expect, given that we've got a lot of barriers to international travel at the moment. And the shares, generally speaking, had a bit of a tick up with the vaccine introduction, but they're flatlining now, and it's a very, very difficult environment for the airlines, and difficult to know whether they would be a good investment at this point and how long the travel disruptions will continue for.
I agree. I think there's a lot of good news already in the price for airlines, and the date at which people will be allowed to fly again just keeps on being pushed backwards.
Yeah.
Okay, shall we move on to our portfolio activities during the week, Richard?
Okay, let's do that, Keith. So my trades, no purchases, no sales for the week, and my portfolio is up 4.4% during
wow.
the week. Mostly because I believe Bitcoin, although I have got a share in a company called Solar Window Technologies, which is a US pink sheet share. And I bought it years ago, and I sort of rather forgot about it. But they're developing a window film that you can put on existing glass and new glass, which it's a photovoltaic film, creates electricity, so you can turn your office building into a power generator. And they have had some very successful trials, and that share has done rather well, and that's made a contribution to my weekly return.
Very good.
Yeah, I'm very concerned about those because these shares on pink sheets in the US are incredibly volatile. So I just thought, last week I said I bought International Biotechnology Trust. This is the weekly graph. The day after I bought it, the shares dropped by about 5%. And this is just to show that timing is, in my view, utterly impossible.
Yeah.
I should have bought a week later, shouldn't I? Anyway, there we are.
Yeah.
Lithium carbonate. So we've covered the price of lithium. The Zinnwald, however, is still continuing not to reflect the generally increasing price of lithium. So I'm hanging in there. And that's me. That's my portfolio review, Keith. Short and sweet this week.
Very good. By the way, Richard, are you aware that the Bacanora Lithium, which is developing this big lithium mine in Mexico, actually owns, I think, half of Zinnwald?
Yes, I was. Yeah.
Yeah.
I think that Zinnwald is a decent proposition. I just think that maybe lithium miners are a bit tired at the moment. They've done very well.
Thank you, Richard. Well, so this is my performance of the week, and I had an up week, which takes me to minus 0.4% on the year. So, substantially behind Richard. I sold two things during the week. I sold some more gold. And I also sold Rainbow Rare Earths, which I made 220% on, and it ticked up. Well, it shot up during the week, and the news that the Chinese were contemplating cutting the export of rare earths to the rest of the world. And I thought, that's enough. I doubt they're going to do it. And anyway.
Well done, Keith.
So what did I buy? Well, I bought some silver. Thank you, Richard. I also bought a load of oil service companies. I bought Petrofac, Hunting, Wood Group. Of those, I like Hunting best. I have prepared presentations or share talks on both Petrofac and Hunting, and we will be recording those when we get the opportunity. I also bought another mining royalty company called Alta Strategies, and I'm working on a presentation on that. And this morning, having updated the weekly report and seen what happened to long rates, I bought some Barclays and I bought some Lloyds. So quickly talking through Rainbow Rare Earths, I bought them back in November at about 6.5p, something like that. And then when the share price shot up earlier in the week, I thought that's enough actually, and I got the high print.
Yeah, well done.
Actually, the highest this chart goes is 20, and I got 20.5.
Well, that's superb piece of trading, Keith.
It's nice to be lucky once so often. Anyway, and when we talk about, the thing is, I think to me, Rainbow Rare Earths was a speculation. I did not want to hold it long term. And, anyone who wants to see the reasons for that, just check out our videos on rare earth metals and the long-term outlook. And Velocys was another speculation. This is a clean energy company that I don't frankly believe in that very much. And, again, so this is my trades in it earlier in the year. I bought some, it shot up, I sold it, it faded off again. And
too, Keith.
Yeah, well, that's all right. Maybe 50%, something like that. But, in my experience, now the purist would say that, you buy your winners and you should run these. And by selling them, you miss out on the chance of, your 10
baggers.
Your 10 baggers. But I've had too many experiences where these sort of stocks tick up and then tick back down again. Yeah. And, I prefer to take a bit of profit and reinvest it somewhere else. Anyway, so I think that is it for the week. Thank you for all listening. We are getting very close to 100 subscribers. It's amazing. So on that note, I hope you will press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.